And welcome back, students who are taking financial accounting. And in this series of videos, we are working on the Chapter 8 problems from Group B that were assigned in the digital study guide. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help. So let me zip down here. Okay, 57. It says here, Cottage Cafe acquires Don's Diners. The financial record of Don's Diners include. Okay, so we're looking at Don's Diners, right? Cottage is buying Don's Diners. Right, so the book value of the assets are 2.6 million. The market value of the assets is 2.7 million. And the market value of the liabilities are 1.3 million. Okay. Now it says make the journal entry to record Cottage's purchase of Don's Diners for 1.8 million cash, including any goodwill. How should Cottage Cafe account for this goodwill after acquiring Don's Diners? Explain in detail. Okay. Now, the whole idea here is we have to calculate the goodwill. All right. So remember, assets is equal to liabilities plus owner's equity, right? So we're being given assets, we're being given our liabilities. Now, they're already on the books. We already know what the book value of the assets are, okay? And we also know what the book value of the liabilities are. However, the market value is generally going to be equal to the book value of your liabilities, right? Why? Because if my books say I owe 1,000, why would anybody else want less than 1,000 as a market value? Or why would anybody, give more? So generally, market value and book value are the same thing when it comes to liabilities. However, with assets, it's not. Okay? With assets, it's something you own, and the value of that asset can be different from what you paid. All right? Now, we have this idea, since we're talking about goodwill here. If we take our assets minus our liabilities, that'll give us our equity, right? Well, the equity is the net worth of the business, or in this case here, how much goodwill over and above because our assets are greater than our liabilities, or vice versa, right? So if we start out with goodwill, in order to calculate the goodwill, we're going to start out with the purchase price. It says purchase of Don's Diners for 1.8 million in cash. So I have cash for 1.8 million. Okay, and that includes any goodwill. Right now, excuse me, we know what the market value, let me erase that. The market value of the assets are 2.7 million. Okay, and we want to subtract out less the market value of the liabilities, right? Which in this case here is 1.3 million, right? So when we subtract the two, we end up with a difference of 1.4 million. Okay, so this ends up being the market value of the net assets. Okay, right? The difference between the market value of the assets and the market value of the liabilities gives us, quote unquote, this equity here. Okay, and then we subtract that from what is actually being paid. Okay, and that becomes our goodwill. So we end up with 400,000, or 0.4 million 0.4 million or 400,000, right? That ends up being our goodwill. So again, very, very basic and simple, all right? Let me just quickly erase a little bit here. All right, okay. All right, we know our assets is equal to liabilities plus equity, right? So when a business ends up being liquidated, you have to take all of your assets and sell them off in order to pay your liabilities. And anything left over ends up being your equity or your net worth. Well, if we're being paid 1.8 million, right, over in cash, if we have to look at the market value of our assets, which was 2.7 million, and then we subtract out those liabilities, 1.3 million, in order to be able to get the market value of the assets of 1.4 million, right? Well, we're being paid cash of 1.8 million for something that's worth 1.4 million, and the difference between the two ends up being the goodwill of 0.4 million or 400,000. Right? It's just that simple. All right. So pause the video and write this down because I have to make the journal entry. Okay, so excuse me. If we have assets of 2.7 million, all right, we're going to debit our assets for 2.7 million. Okay, and we have liabilities of 1.3 million, so we're going to credit our liabilities for 1.3 million. We're going to credit cash for 1.8 million, because remember we're looking at Cottage Cafe, right? Cottage is paying the 1.8 million, right? So that's 1.8 million is leaving the business in cash. We're getting Cottage is getting the assets, so that's why it's a debit to the assets for Cottage, and it's also picking up those liabilities or the credit, right? Because we're looking at from the perspective of Cottage. Right? And of course, the difference between the two, which is a double check, is the 400,000. All right, or the $400,000 of goodwill. So if you did all of those calculations and you came out with 400,000, you could be thinking, well, is that number right or wrong? Well, then let's go ahead and make this journal entry and see if we're right, or wrong. When I put my assets on, right, I have debits, credits, right? I have 2.7 million. For my credits, I have 1.3 million and 1.8 million, and that total is 3.1 million. Well, the difference between the two is 400,000. Okay, debits have to equal credits, so I have to I have to debit my goodwill for 400,000, and it's just that easy. I can back into knowing whether that goodwill is a debit or a credit. Okay, I don't have to memorize which it is. All right. You could have calculated the 400,000, all right, but if you're trying to figure out whether to make it a debit or credit, just back into it. My debits have to equal my credits, and that's all there is to it. Okay. All right. So now it says, how should Cottage Cafe account for the goodwill after acquiring Don's Diners? Explain in detail. All right. So the answer in the solution manual says Cottage Cafe should measure the fair value of its goodwill each year. If the goodwill has increased in fair value, there's nothing to record. But if the goodwill's fair value has decreased, then Cottage Cafe should record an impairment loss and write down the goodwill. All right, which is true. All right. So remember, if you read the section on goodwill, you'll see that you start out with whatever the goodwill is. If goodwill increases, you don't have, you don't show that additional goodwill on your books. However, if the goodwill decreases, you can write that off as a loss in order for tax purposes. Okay, so let's see here. Yep, I'm going to stop the video here. All right. Again, if you didn't understand something, pause and rewatch the video. Go back and watch the theory videos, and if you still don't understand something, feel free to contact an instructor. I'll see you in the next video for what seems to be depletion. Okay?